Yes, let's get started. So the first area that we are going to cover in this video is what exactly is meant by international tax. Okay, international tax. International tax. Let's see. International tax. So when we say international tax, what do I mean by international tax? See, international tax means international tax covers international aspects of income tax laws or income tax systems of different countries. International tax covers international aspects of income tax laws and income tax systems of different countries. Now, what do I mean by this? International aspects of income tax systems or income tax laws of different countries. I'll just explain this to you. In fact, this means this would explain to you the transactional nature of international tax. See, I'll give an example. So this is our country, our beloved India. You have India here, and you have US here. Fine. Okay, so we have India here, and you have US here. India and the US, and you would find that Indian investors, Indian residents wanting to invest in the US. So Indian investors wanting to invest in the US. These Indian investors, Indian residents, these residents can be natural persons, can even be legal persons, for example companies. So they are residents here and they are investing in the US. Similarly, you would have US residents, natural persons as well as US companies. They might be willing to invest in India. This is how the international trade takes place. Fine. So you have this. Fine. So these are residents here and these are residents here. Fine. So now we have two transactions. Indian residents going abroad, investing in the US, and US residents coming to India, investing in India. Now, from the perspective of India, if you analyze these two transactions, see, from the perspective of India, this becomes an outbound transaction because money is flowing, the investment is flowing out of the country. So this is outbound transaction. XNS transaction. And from the perspective of India, this becomes inbound transaction, right? This is inbound transaction. So outbound, investment flowing out of India, and inbound, investment flowing into India. Now in the current global economic scenario, both these would rise. India is supposed to be doing exceedingly well. So the Indian investors would continue to invest abroad, as well as the wealthy residents, both legal persons as well as natural persons, they would invest in India transactions. Fine. So from the perspective of India, this is outbound transaction, this is inbound transaction, and from the perspective of the US, this becomes an inbound transaction, right? And this becomes an outbound transaction. Outbound, right? Outbound transaction. So when we talk about international tax, I mean, I've told you that international tax covers international aspects of income tax systems of India and the US. So this, I mean, how would the Indian income tax system, how would the Indian income tax laws treat this outbound transaction, and how would the Indian income tax system treat this inbound transaction from the perspective of taxation. So taxation of these two transactions, outbound as well as inbound. Similarly, from the perspective of the US, how would the US taxation system would treat this inbound transaction as well as outbound transaction. So this covers international tax. This is what is international tax. Fine. This is one area of international tax which covers inbound and outbound transactions for the countries involved. Now, this directly leads you to the second aspect of international tax, that is comparative tax law. Because when you're talking about the Indian taxation system as well as the US taxation system, what do you have? You can simply draw a table. You can write comparative taxation taxation or tax laws, comparative taxation. You can have India as well as the US. How does Indian tax system treats the outbound transaction vis-a-vis the treatment of the outbound transaction by the US, and similarly how does Indian tax system treat the inbound transaction vis-a-vis the treatment by US of the inbound transaction. Now this is at a very, very high level. Of course, there would be number of there are number of differences in the tax system of the US and tax system of India. There are number of rules which are, in fact, the US tax system is one of the most, probably the most involved and advanced tax system in the world, and there are number of rules and regulations in the US tax system, international tax system, which are not present which are not seen in the Indian scenario. But then this is the comparative aspect. So comparative tax law, comparative taxation, this is also one other aspect of the international tax system. Fine. So two areas I've already mentioned. International tax. What is international tax? Deals international aspects, inbound and outbound transactions, individual countries. Secondly, comparative taxation, inbound and outbound transaction. This is the first area. Second area is the comparative taxation, and then there is a third area also which also gets covered within the folds of international taxation. For that I'll have to just rub this. I'll just do that. Fine. It's a wonderful diagram. Yes, I must say this. Okay. So the third aspect of international tax is the transnational taxation. Transnational taxation. So I'll just draw this as well. Transnational. Third area of international tax which is included is transnational tax. Now, what do I mean by transnational tax? See, at the global level, at the truly international level, the global bodies, what do you have? You have United Nations, you have even the International Monetary Fund, you have the World Bank, as well as the de facto leader of the international tax regime for the last 60 years, OECD. United Nations, IMF, World Bank and the OECD, Organization for Economic Cooperation and Development. These are the international bodies wherein a number of countries of the world, more than 100, 150 countries, United Nations, almost every country of the world is a member of United Nations. OECD inclusive framework as of now, is comprised of 141 countries. So countries gather in these multilateral fora, the global fora, and then they thrash out, they try to find out solutions to the problems which the tax systems of different countries are currently facing. For example, the problem of tax evasion, tax avoidance, tax fraud, shifting of the profits. These are the problems which are being tackled at these global bodies. These global bodies, they create the soft law version. For example, they create multilateral instruments. They create a model tax convention. OECD has a model tax convention upon which tax treaties are based. They also devise conventions. They also create conventions for information exchange, wherein information can be exchanged between tax administrations of different countries, information exchange as well as assistance in the collection of tax matters. So this is the work, the policy matter. This is the work which is being done at these global level, majorly at the OECD level, also at the United Nations, and yes, IMF and World Bank, they also come up with certain policy papers and certain issues. So this all is within the folds of transnational tax, the truly international aspect, wherein all the countries, they pool their efforts, they pool their resources, they coordinate their efforts to solve the problems which are being faced by the tax systems of almost every country. Fine. So therefore, summarizing this entire discussion of international tax, inbound and outbound transactions. How do the country's tax system deal with inbound and outbound transactions? Number one, number 2 the comparative tax law, and number 3 the transnational tax. So this entire body of knowledge, this entire area makes the international tax regime, the international tax architecture in the present world. Fine. So this exactly can be a brief description of what international tax